Let me be very direct with you. I've been managing money for over 40 years. I worked alongside George Soros. I ran Kaizen Capital. I compounded at 30% annually for 30 years without a single losing year. And right now, I am more concerned about what is coming for American retirees than I have been at almost any point in my career. I want to say that again because I need you to hear it. I am not talking about a dip. I'm not talking about a correction. I am talking about a structural shift in the financial system that most people, including most professionals, are completely unprepared for, and the people who will be hurt the most. People who did everything right. People who saved their whole lives. People who put money in a 401, maybe have a pension, maybe some CDs, maybe some bonds. People over 60 who cannot afford to lose 30, 40, 50% of their net worth and simply wait for it to come back. Because here's the brutal truth nobody on television will say to your face. When you're 40 and you lose half your portfolio, you recover. When you're 67 and you lose half your portfolio, you don't. The math doesn't care about your feelings. The market doesn't care about your age. And Washington certainly doesn't care about your retirement. So today I'm going to tell you exactly what I see happening in the next 90 days and what I believe you need to do about it. Not tomorrow, not next month, now. Let's start with the basics, because I think there's enormous confusion out there about what's really going on in this economy. Most people look at the stock market and they think, well, the market's up, things must be fine. That is one of the most dangerous assumptions you can make. I want you to understand something that took me years to truly internalize. The stock market is not the economy. And right now, the gap between the two is enormous. Here's what I'm actually looking at. The United States government is running a deficit of approximately $2 trillion per year, not total debt, per year. We are adding 2,000 trillion to the national debt every single year. When I started in this business, the entire national debt was under $1 trillion. Today we are adding that every 6 months. And here's what that means in practical terms. The U.S. Treasury has to sell bonds. Lots of them. Every single week to fund that deficit. And as they sell more and more bonds, they put upward pressure on interest rates. Now, why does that matter to you? Because interest rates affect everything. They affect your mortgage. They affect corporate borrowing. They affect how companies are valued. They affect pension funds. They affect everything. And right now, we have interest rates at levels we haven't seen in 15 to 20 years. And the government is borrowing more, not less. I know the Federal Reserve declared victory on inflation. I know the official number came down. But I want you to think about what you're actually paying at the grocery store, what you're paying for car insurance, what you're paying for healthcare, which, if you're over 65, is probably your biggest expense. The CPI, the Consumer Price Index, the government's official inflation measure, does not capture what retirees actually spend money on. It never has. It was designed for the average working age American, not for someone who is spending 30% of their budget on healthcare and maybe living on a fixed income. Real inflation for retirees is higher than what they're reporting. It has been for years, and that gap is quietly destroying purchasing power. Here's a word I want you to remember: liquidity. It means how easily you can turn something into cash without losing value. Right now, there are certain parts of the market that look fine on paper, but are extremely illiquid. Certain bond funds, certain real estate investment trusts, certain alternative investments that banks sold to retirees promising steady income. When panic hits, and in my 40 years, panic always eventually hits. These instruments don't go down gradually. They seize up. You try to sell, and there are no buyers, or the price drops 30% before you can get out. This is not theoretical. We saw it in 2008. We saw a version of it in March 2020. And the conditions today, the leverage, the debt levels, the interest rate environment, are more fragile than either of those moments. Now let me be specific about the next 90 days, because I think this window matters. I am watching four things very closely right now. Four things that, if they move in the wrong direction, and I think there's a real chance they do, are going to create serious pain in financial markets. Every week, the U.S. government holds auctions where it sells bonds. Foreign governments, banks, pension funds, they buy these bonds. This is how the government finances itself. In recent months, we have seen what's called weak demand at these auctions. That means buyers are showing up, but not as enthusiastically as before. They want higher interest rates to compensate for the risk of lending to a country that is 34 trillion in debt and counting. If we see a truly failed auction, or a series of auctions where demand falls significantly, you will see interest rates spike very fast, and that will ripple through everything. The second thing I'm watching is commercial real estate. This is a crisis that has been building quietly, and the mainstream media has largely ignored it. Banks, particularly regional banks, are sitting on enormous losses in their commercial real estate portfolios. Office buildings, shopping malls, certain types of apartment complexes. These assets have lost 30, 40, sometimes 50% of their value since interest rates rose. The banks haven't been forced to recognize those losses yet. They've been kicking the can down the road, but loans come due. And in 2024 and 2025, a massive wave of commercial real estate loans are maturing and needing to be refinanced at much higher interest rates. When banks have to finally absorb those losses, it creates a credit crunch. They lend less. Businesses struggle. Unemployment starts to creep up. The third thing I'm watching is the American consumer. The American consumer has been remarkably resilient, but that resilience has been funded by credit cards and savings that were built up during COVID stimulus. Both of those buffers are running out. Credit card delinquency rates are at their highest levels since 2011. Auto loan delinquencies are spiking. The savings rate has collapsed. When the consumer slows down, and the data is telling me we are very close to that point, corporate earnings follow. And when corporate earnings disappoint, the stock market reprices quickly and painfully. The fourth thing I'm watching is the Federal Reserve's impossible position. Here's the bind the Fed is in, and I want you to really think about this. If they cut interest rates to stimulate the economy, inflation could come roaring back. Because we still haven't fully resolved the supply chain issues, the energy transition costs, the labor market pressures. If they keep rates high, the debt service on 34 trillion becomes crushing. More bank stress, more corporate defaults, more pain in the economy. There is no clean solution here. There is no magic landing. The Fed is trying to thread a needle in the dark. And when central banks are in an impossible position, markets tend to eventually figure that out. And they react badly. All four of these things could come to a head in the next 90 days. Not necessarily all at once, but a spark in any one of them could set off a chain reaction. Now, let's talk about what this means for you specifically. I want to address this directly to people who are retired or close to retirement, because the advice you hear on television, stay the course, don't panic, think long term, that advice is designed for a 35-year-old with 30 years of earning potential ahead of them. It is not designed for you. When you are in retirement or close to it, you operate by a completely different set of rules. And the most important rule is this: Capital preservation comes before growth. I don't care how good an investment sounds. I don't care if your broker tells you this stock is going to double. If losing that money puts your retirement at risk, your ability to pay your bills, your health care, your housing, then the potential upside is not worth the risk. Period. If you are over 65 and you have more than 50 to 60% of your portfolio in stocks, you need to have a serious conversation with yourself about whether that's appropriate. I am not saying sell everything. I am saying understand what you own, why you own it, and what would happen to your lifestyle if those positions dropped 40% tomorrow. If the answer to that last question is that you'd be in serious trouble, then you have too much risk. A lot of retirees were sold on bonds as the safe part of the portfolio. And for most of financial history, that was largely true. But here's what happened. When interest rates were near zero for over a decade, bond prices got inflated to enormous levels. Then when rates rose, which I and many others warned about, bond prices crashed. Long-term Treasury bonds lost 40 to 50% of their value. Investment-grade corporate bond funds lost 20 to 30%. Many retirees who thought they were safe in bonds got absolutely crushed. Now, I'm not saying all bonds are bad. Short-term bonds, things maturing in 1 to 3 years, are actually quite attractive right now. You're getting 4 to 5% with very limited interest rate risk. But long-duration bonds, 10, 20, 30-year treasuries, those are still very risky if rates rise further, and I would not be overweight them right now. For years, people were conditioned to think that holding cash was stupid because it earned nothing. Cash is trash, they'd say. Well, cash is earning 4.5 to 5% right now in money market funds and short-term treasuries. That's real money. That's not garbage. And more importantly, cash gives you options. If markets fall 30% and you have cash, you can buy assets at dramatically cheaper prices. If you're fully invested and markets fall 30%, you have nothing to deploy. And you've just watched your retirement savings evaporate. Having 20 to 30% of your portfolio in high quality, short-term cash equivalents right now is not being a coward. It's being smart. In my experience, the investments that blow up most spectacularly are always the ones that were sold as guaranteed income or alternative income or inflation protected with lots of complex fine print. Annuities can be appropriate, or they can be loaded with fees and surrender charges that trap your money. Know exactly what you own. Private credit funds, real estate interval funds, structured products. These can be legitimate, or they can be illiquid bombs waiting to go off. If you can't explain in plain English how an investment makes money and how you get your money back, you should not own it. Now, I want to be careful here because I am not your financial advisor. I don't know your specific situation. What I'm going to share is my perspective, how I think about positioning in an environment like this one. I would look at the most volatile, most speculative positions in the portfolio, and I'd be reducing them, not because I'm certain they'll fall, but because the asymmetry is bad. The potential downside is too large relative to the upside. Anything with high debt, anything in commercial real estate directly, anything in long-duration bonds, I'd be trimming. I would own some gold. I have been skeptical of gold for much of my career, but I've changed my view in recent years, and here's why. When governments are running deficits of this magnitude, and when there is genuine uncertainty about the dollar's long-term position as the world's reserve currency, gold serves a purpose that nothing else does. It is nobody's liability. It cannot be printed. It cannot be defaulted on. I'm not talking about putting 50% of your portfolio in gold. I'm talking about 5 to 10% as insurance against a genuine fiscal crisis. If everything goes fine, you've lost a little potential return. If things go badly wrong, gold protects you. I would own some international exposure, selectively. The United States has outperformed international markets for a decade. That's true. But the valuation gap between U.S. stocks and international stocks is near historic extremes. There are parts of the world, certain Asian markets, parts of Europe, where you can buy quality businesses at dramatically cheaper valuations than you can in the United States. This provides some diversification if the U.S. goes through a rough patch, and I would have a cash cushion that covers at least 2 years of expenses. This is the one recommendation I feel most confident about. If you need to take money out of your portfolio for living expenses, you should have 2 years of those expenses sitting in cash or very short-term instruments, not in stocks, not in long bonds. That way, if markets fall hard, you are not a forced seller. You can wait. You can be patient. The market can recover, and you never had to sell at the bottom. This is not glamorous. It's not exciting. But it is the difference between a rough market being a temporary setback and it being a catastrophe. I want to leave you with something broader, something that's been on my mind a lot. I've lived through a lot of market cycles. I've seen recessions. I've seen crashes. I've seen bubbles. And every time when you're in the middle of it, people say, this time is different. Usually it's not different. Usually the same patterns repeat. But I want to be honest with you about something. The debt levels we are now dealing with globally are genuinely unprecedented in peacetime history. We are in territory that has no real historical precedent for resolution without significant pain somewhere. The question is only where that pain falls. On savers through inflation, on bondholders through default or restructuring, on taxpayers through austerity, on the currency through debasement. I don't know exactly how this resolves. Nobody does. Anyone who tells you with certainty how this ends is selling something. What I do know is that in environments of great uncertainty, the investors who survive and thrive are the ones who protect their capital first, who live to fight another day, and who keep their options open. The ones who get wiped out are the ones who are fully committed, fully leveraged, fully invested, with no margin for error, and then something unexpected happens. Right now, I believe we are in one of those periods where having margin for error, having dry powder, having some humility about what you don't know, that is more valuable than any specific hot investment idea. The next 90 days will be telling. Watch the treasury markets. Watch the regional banks. Watch consumer credit data. These are the canaries in the coal mine. And if they start singing, don't wait to see what comes next. Move before the crowd moves. Because by the time it's obvious to everyone, it's too late. Look, I'm not here to scare you. I'm here because I think you deserve straight talk. You worked your whole life for this money. You sacrificed. You delayed gratification. You made the right decisions decade after decade. You deserve to protect that. You deserve to understand what's happening, not in some watered down, don't worry, be happy version, but the real version. So take this seriously. Have the conversation with your financial advisor. Ask hard questions. Push back if the answers don't make sense. If you don't have a financial advisor, find one. A fee-only fiduciary. Someone who is legally required to act in your interest, not someone earning commissions to sell you products. And remember, doing nothing is also a decision. Staying positioned in a way that leaves you exposed to serious risk is a choice. Just because you didn't pull a trigger doesn't mean you didn't make a decision. The next 90 days matter. Move intentionally. Move thoughtfully. But move.